Welcome back. The publicly traded alternative asset managers plummeting this morning as redemption concerns back in focus. Partners Group capping back half of the nearly 10% redemption requests for one of its evergreen funds in the second quarter, according to a report by Bloomberg. And then yesterday, Cliffwater Corporate Lending Fund received redemption requests totaling 17%, allowing only 5% to redeem, consistent with the fund's prospectus. Now, we heard a lot about the software fallout for private credit on the way down, but software stocks have soared 20% over the last month, and the alt managers have really failed to keep up. Glenn Schorr of Evercore ISI published a note yesterday which found that the correlation between the software ETF, IGV, and the alternative asset managers has broken down in recent months from a historical level of 0.72 to 0.4 for April and May. He said, quote, "If the correlation stays patchy, it suggests that the alts problems run deeper than their software portfolios alone and are more a function of the private wealth channel drying up." Those concerns are central for the moves in alts you're seeing today, CQ, because these redemptions suggest that people are taking money out of these types of products, of these types of vehicles, as opposed to kind of making this more of a growth area for the alternative asset managers. And that's why you've got this sentiment kind of rethink going on.
Right. What would drive redemption pressure if it were something other than software fears?
That's the question. And that's why this correlation is so interesting right now, because what we saw in the first quarter was it really was software fears. There were some defaults. There was some concern about valuations and marks in other areas in the portfolio. But really, it was software front and center and their outsized exposure to it as the publicly traded software stocks fell. Now you see this correlation kind of shifting, and the concern is about private wealth channel and whether that's still a growth area for them. And does that happen kind of regardless of the health of the portfolio if defaults stay okay? And also, by the way, interest rates rising is seen as a good thing for private credit. So the fact that those aren't necessarily coming down anytime soon should also be a tailwind that we're not seeing.
I keep thinking about the clash between the concerns over redemptions and your conversation with Solomon at the Economic Club, where he talked about more greed than fear overall, and actually a great liquidity environment. Yes?
Yeah, well, I think he was talking about the publicly traded equity environment for that greed versus fear dynamic. I think it's probably less true in the private markets, which are technically riskier than the publicly traded equity markets. But I was asking him about, the Alphabet deal, which we saw this morning was upsized. We saw the SpaceX IPO looking like it's going to come in at the higher end of what people had been discussing as a possibility there, $75 billion offering. So, yeah, it's definitely out there in the equity markets.
I mean, it points to the ongoing, I wouldn't call it fear, but attention to importing risks from private markets into public markets at the same time where household exposure to equities is essentially at a record high. That's kind of the environment that we're in.